Hello, everybody, and welcome to the fifth episode of Mortgage Basics. We're going live today, and we have a guest from National Credit Care coming to help us discuss some credit tips. So I will bring him in right now. Anthony, welcome to the call. Thanks for joining us.
Jeff, thanks so much for the invitation. Good talking to you. Good seeing you.
You bet. So just for a little brief recap, we're just going to talk about kind of how we met. We actually both got into the industry at about the same time 10 years ago, and we met in 2011 when I was working at Academy Mortgage, still working for my dad there. So it's been quite a while.
Yeah, it's funny. We're full circle 10 years later. Technology is pretty incredible, and I had a little bit more hair back then, but at least we're still plugging along, right?
Well, absolutely. I mean, I was an assistant to my dad's team back then, and then you were also in a different role. So I've kind of progressed into being, my own loan officer here, and you're regional director now for National Credit Care. So that's great. It seems like we both had some progress along the way as well.
Yeah. When I initially started, I was, quite frankly, the low man on the totem pole of an organization of about 35 at the time, 35 total employees, and I was really kind of assisting. My predecessor was the regional director of the Pacific Northwest, and he had aspirations of doing something else within the organization, and it kind of thrust me into this position. Shoot, about 9 years ago. So I've been the regional director really ever since, kind of running up and down the Pacific Northwest, really living on I-5, quite frankly, for almost 10 years. Bellingham down to Vancouver, Portland down to Medford. So
That's a
I've
bumpy
handled it
decade.
all, and yes, yeah, it's a lot of window time, but not a beautiful place is the Pacific Northwest, and we're based out of Denver, so I've been pretty blessed to have some really awesome places, and especially during those time frames to watch a place like Seattle and Denver kind of grow into what they are now has been is quite a lucky experience.
Definitely. And I was born in Aurora, Colorado. So it's just kind of like a big loop of things that we have in common there. So that's kind of a
Yeah,
fun way
yeah,
to
I
be able to
forgot.
connect.
Yeah. Yeah, but I'm sure you missed the sunshine a little bit. I would presume. I know that you were younger when you lived out here, but you know,
Yeah,
300 days
I
of
actually do
sunshine
like
aren't
the
bad.
rain. I do like the rain quite a bit, but the change of scenery, I've been to Colorado just once. I drove out there and I really did enjoy it. So I'll be looking forward to get back out there. But anyways,
Sure.
I thought we'll kind of jump into the call. I wanted to have you on for some credit advice. I know a lot of turmoil in the industry right now with uncertainty in the marketplace, a lot of changes in the mortgage and lending world. So I thought it'd be a good time to check in and see what's going on in the credit world and what you're seeing kind of from a credit repair side as what you're able to do helping people improve their scores, and just kind of break it down a little bit from your side.
Absolutely. It's been unprecedented times, quite frankly, in credit restoration in the last, let's call it the last 120 days. COVID has really thrown everything for a big speed bump, a big loop in regards to creditors' ability to verify information. The premise of
Mm,
credit restoration is the inability or the ability of a creditor or debtor to verify negative information that they're reporting against you, whether it's medical bills, collection accounts, late payment history, repossessions, things of that nature. Due to the fact that COVID has kind of shut down some of these larger call centers nationally as well as locally, we're actually seeing a giant uptick in credit restoration score increases. Historically
mm,
speaking, we've always averaged anywhere from about 14 to 18 points a month, and that's been pretty darn consistent for the last 10 years. In the last 120 days, our analytics have shown that those numbers have gone up to about 20 to 24 point or 20 to 22 point score increases, which is around a 25-30% increase in overall point total that we're getting our clientele nationally, which is, I'd
wow.
like to say that we have a better product and we found a new magic wand over here, but unfortunately, it's just due to circumstance, and we've really been taking advantage of it as well as a clientele. But really, more importantly, it's lenders like yourself that have seen the opportunity for their clients not only to get lendable, but to get rates at a historic low. It is not a good financial decision to get locked into any sort of financing with marginal credit at this point. Things are historically low from a rate perspective. You know, Credit restoration is not just for someone who has a sub 600 credit score. People that are in the 640, 650 range
Mm,
want to get to 680, want to get to 700. Rates. I'm sure that you can touch upon it more than I can. Rates being in the low threes. It doesn't make sense right now just to kind of jump on board and get financing done at a 620, 625.
Well, I mean, especially there's a lot of things. Not only is your rate impacted by your credit score, but if you have mortgage insurance, your mortgage insurance premium will be a different level or a different premium factor at different credit scores. So you can benefit your payment in multiple ways by increasing that score. And it really is a big deal. I mean, even going from, a 690 to over a 700, maybe they only have to work with you for a month or two to get that or get some insight that can really be helpful and it can really be impactful. I mean, I don't want to quote hard figures out here, but if you've ever looked at a mortgage scenario, you can sometimes tell the difference between those two, and it's definitely worth looking at.
Yeah, I mean, we obviously are married to the mortgage industry because 95% of our clientele are in the midst of the home buying process. So we do have a lot of analytics that show, really true savings on some of these mortgage products. We have the ability and we have technology internally to amortize a mortgage at a 620 and amortize a mortgage at a 720, and the savings are it's life changing. It's life altering money, tens of thousands of dollars saved by just simply having good credit. And oftentimes, some folks that are at a 620, 630, 640 credit score, it might not even be detrimental, a detrimental file. It could be $300-400 worth of medical debt, and it's going to cost you $60,000-70,000 in interest over a 30-year fix because you have $400 worth of medical debt on your credit report during the time in which you're looking to get financeable for a home loan. So
Right.
it's incredible the volatility of the algorithm approved by Fannie and Freddie for specific mortgage lending.
So, for example, if someone's maybe putting 10% down, but they have a few credit issues, it could even be a better idea for them to put 5% down or even 7% and then use the rest to clean up their credit, maybe even wait a month or two and see if that payment is different by $50 a month or so and saving you thousands of dollars in interest, like you said, over the lifetime. And one
A
thing I want
hundred,
to
a
key in
hundred
that's
percent.
really going to be powerful on the 30-year products. 15-year loans are not as sensitive to credit scoring, but it's still going to be impactful. But really on that 30-year program, huge impact there.
Yeah, and I think a lot of times fixing your credit oftentimes doesn't even have to be that big of an investment. A group like ours, which are fully licensed and bonded and accredited in all 50 states, the state of Washington sets forth the price in which we're allowed to charge. At a mere $79 a month, poking around a program like ours for 2, 3, 4, 5 months, what have you, can save you, $79 a month on a monthly mortgage payment. Extrapolate that out over 360 payments that you might have on the life of a loan. It's peanuts. It's not even peanuts. It's it's minuscule and a flake of sand in regards to the ultimate saving in regards, obviously with the
Really, yeah, in the big picture, when you can
interest.
extrapolate it out over the whole term, it really is significant. So, what do you see as being the best opportunity on average? Of course, everybody's situation is different, but when it comes to collections, charge-offs, medical bills, late payments on student loans, where are the usually biggest areas of opportunities that you see you can make some adjustments, get some quick score increases, and really start working on
You
something
know,
that they might not be able to do.
really, really what we're seeing from a score perspective where we see the highest jumps, the best resolution is always going to be medical debt. Medical debt, quite frankly, is half the reason we're in business. Medical debt oftentimes is easy for us to kind of get navigated off of a credit report because,
Okay.
due to the fact that, creditors must provide verifiable evidence. Most creditors are not going to be able to obtain documentation, mainly because no medical institution wants to violate HIPAA. So releasing an invoice on a medical bill, a delinquency notice, an insurance provider, that's information that a creditor simply is not going to be able to obtain on medical debt specifically, and we have the high success rate on medical debt.
So even though sometimes we can not even we don't have to worry about medical debt sometimes with loan approvals, you still might want to address that in the overall scenario because, like we said, everything's going to be credit based on your pricing.
I think I think true, Jeff. I think that's the biggest mistake that I still see today with a lot of my loan officer referrals is that when they look at a credit report, they're skipping over medical debt. I understand that you don't need to hold that against the ratios, and you can get a DU approval with negative collections that are medical related through. But first base of any transaction is always going to be the credit score. You can have a down payment, a gift, doing a rent to own. If you're at a 550 credit score, you're dead in the water.
Yep.
What we have the ability to do is get that 550 to his 580 or 620, what have you. And a lot of times, it's the medical debt is the quickest and fastest way to get there.
Well, and also we want to, I mean, I want to advise people in a way to let's get them in the best scenario possible before they incur a large debt of a home. Typically, right, it's going to be the largest debt of anyone's entire life. And so let's get you in a good position before you get there. I think that's really powerful to help advise and make sure that people are set up for success.
Yeah.
Okay, so another question I have for you. So we've kind of gone over a couple of the points of what's going on right now with the uncertainty, as well as some opportunities there. Do we have any free nuggets? Like one of the things that I constantly hear is keep your credit card balance at 30%, and that'll help keep your credit score in the good range. Do you have any small tips like that are easy to implement, or best practices that we can do to make sure we're keeping our credit scores in a good zone, other than just keep making our
Yeah.
payments on time, which should be a given, hopefully.
You'd think that was an obvious one, but I've had some doozy conversations where folks, think, hey, I'll get caught back up next month. It's only 30 days. It's only one time. Jeff, I've seen people's credits drop from a 750 to a 650 with one 30-day late payment on like a retail store Macy's card. So again, I want the folks out there to understand that every little bit of negative information impacts you tremendously. But some tidbits and some little nuggets I can share is, 30% is a good rule of thumb. That's where you start hemorrhaging really the most points on your credit profile. In an optimal situation, you'd like to carry balances below 10% balance to limit ratios. And understand it is not cumulative debt, it is per card. So attack the smaller cards to get those balances below 10%, then below 10%. That's going to give you the biggest bang for your buck the fastest. Um,
Okay.
another big no-no that I see is folks that are paying open and active collections. I know that you want to do the right thing. I know that you think that you may need to do that from an underwriting perspective, but before you sit down and consult, or don't do anything before you sit down and consult with a loan officer. Paying collections will adversely affect the score. The score is predicated on reporting dates, not monetary debt. When you old collections, all that happens is the balance is updated to zero and the date of last activity becomes current. A $10,000 collection reported in June of 2020 and a $0 collection reported in June of 2020 will both adversely affect the score at the same rate. The algorithm only picks up the negative trade line. It does
Wow.
not pick up the amounts owed.
That's probably
And I
a
think
huge
lastly,
misnomer. I'm sure
yeah,
that's gotta
go
be
ahead.
a big unknown factor right there.
Yeah, you know what, Jeff, do what I've seen again, you've been around as long as I have, shoot, we've grown in this business together, is we're steering away from the days of going into a mortgage office and sitting down with your loan officer, having a conversation, going over a credit report. So many things are done over line now on your phone.
Mhm.
We live in such a tech world right now. It's just there's things that people are just jumping to their own conclusions or getting the wrong information online. There's a lot of misinformation out there. Culprits like the Credit Karmas of the world that miscalculate scores, things like that. It's giving too much. It's making your position, quite frankly, a little bit more difficult because folks are doing their own homework. They're not finding the right information. They're implementing wrong practices before they sit down with a mortgage professional and actually pull a credit report to find out they've just shot themselves in the foot.
Or the other thing that can be happening too is, I mean, some people really are like with the state furloughs just happened in Washington that were kind of surprise announcement for many of the workers here. And then maybe if they did lose their job because of what's going on, maybe they did get behind and now they're worried for the first time. I don't know, or maybe not the first time, but they could honestly have gotten behind because of a hardship. And so it's great to provide a resource of where they can reach out and maybe get some advice going forward on how to rebuild that. It's not always that you made a bad decision or you had bad advice. Sometimes you might just have not been able to do the right thing. So for those people, we
Sure.
try to provide the right service and give them some advice and some of these free nuggets like we just talked about of try to, make payments on time as best you can, and follow some of these tips to hopefully have the best shot.
Sure. Yeah, and I think the great thing about National Credit Care is it doesn't cost anything to talk to us. I mean, we have consultations for free all day. We'd love to help anyone and everyone if it's just some just general advice up until maybe a long-term rehab on someone's credit profile. We're here to help. We're here to serve the community, and more importantly, partner with mortgage professionals throughout the country to help some of those folks overcome those hardships or obstacles in regards to credit, and that are kind of obstructing them from the ultimate dream of becoming a homeowner and do obviously with with where the rates are now and how healthy the credit, how healthy the real estate market is, there's not a better time to kind of get this done.
Well, I agree, and I wanted to thank you for all your advice today. I mean, we kind of ran through a quick episode, but here we're coming to a 15-minute mark, so want to keep this one fairly short and compact so it's digestible. And Anthony, just want to thank you for your time. It's been great to chat with you and see you, and I'll look forward to doing some business together in the future here.
Absolutely, Jeff. Thanks so much. And I do want to throw this one last tidbit out. If any of Jeff's viewers or listeners want to give us a buzz for a free consultation, we will give her a free soft pull, master credit copy report from TransUnion, Equifax, and Experian. It will be a soft inquiry. Will not show up on a credit report. You won't lose points as long as you mention Jeff in this video. We'd be happy to give you a free consultation and a free credit report.
Wow, great. Awesome offer, and we appreciate that, Anthony. So thanks a lot.
Thanks so much, guys. Appreciate it.
All right. Okay, well, I'm going to close out the video. Stay with me on the line, Anthony, and I'll talk to you for a minute after the call, and hang tight there.
Cool.
All right, guys. Thanks for watching our episode today. It was great having you, and I will see you on the next episode of Mortgage Basics. Take care.